All right. We're going to continue our discussion of the finance of mathematics and the mathematics and finance calculations associated with that. And in particular, let's take a look at loans and credit scores to start off with. So can I borrow $20? I'll pay you back tomorrow. Have you heard that? Has someone asked you that before? A classmate, maybe a lab partner, a study part buddy, somebody like that you're working with, has asked to borrow some money, and you have to make a judgment call. You know, if you're going to give that person the money, will that person pay you back? Will you get your money back? And if you're loaning someone a large amount of money, and it's to someone you don't really know very well, what sort of information do you want to know about that person? You know, what sort of factors might affect your judgment on making that decision? Unfortunately, this country has a long history of using the color of a person's skin as a factor in that decision-making process. Although in 1974, the U.S. government made it unlawful to discriminate on loans on the basis of race, color, religion, national origin, sex, marital status, or age. And in an effort to follow that law, FICO, which stands for the Fair, Isaac and Company, Fair, Isaac and Company is the FICO. Fair is somebody's last name. They're trying to be fair in this process, but it's actually somebody's last name there. They introduced the modern credit score in 1989. The goal of the credit score is to turn all that data collected about your credit history through our standard, credit bureaus, Experian, Transvision, Equifax, sort of things that gather credit history about you, turn it into a number that's meant to predict the likelihood that the lender will be paid back the money that they loaned you. Again, it's supposed to be sort of an objective number value, not something that's subjective based on, someone's judgment. Sort of try to eliminate those factors that are listed up above from the loan decision process in there. And so the things that the FICO score looks at, it's your payment history. How much money do you owe? What is the length of that credit history? How long has it been that you've been paying off loans successfully? What types of credit are they used? Are they home loans? Are they consumer loans? Are they, education loans? Sorts of things. Also affecting that would be recent inquiries into your credit score. So if you're applying for a lot of loans, that's going to negative affect you. I mean, they have sort of a grace period in there that if you're applying for a lot of loans, like in a 14 to 20 day period or so, they're looking at, say, okay, well, maybe this person is just shopping around to find the best loan deal. But if you're doing, 3 or 4 loans, trying to look every single month for a long period of time, that might affect your credit score as well. But the primary factors lenders currently use are what sort of income do you currently have, and what is your credit score in there. But inequalities still remain in our system. BIPOC individuals tend to have lower income and lower credit scores. And the result of that is if you have a lower income, lower credit scores, you end up with a larger interest rate and a longer term to your loan. And so in this assignment, we're going to look at some of those financial costs. How does the length of the loan affect things, and how does the interest rate affect the loan, how much interest you pay? And so here is Michelle. Let's take a couple hypothetical people. Michelle has a FICO score of 745, and Manuel has a credit score of 645. Both are interested in purchasing a home for $300,000 and are looking at a 30-year mortgage. So according to our chart at the left that I found at myfico.com, is with a credit score of 745, Michelle would be offered a rate of 4.508%, and Manuel would be offered a rate of 5.329%. So let's take a look at those. Michelle's $300,000 loan for 30 years at 4.508%. We want to start with asking maybe how big are Michelle's monthly payments going to be. And this uses the future value annuity or the present value annuity formula. With a loan, you have a large sum of money that's earning interest, and then you're withdrawing or you're making payments that reduce the balance. The balance is going up because of the interest, but your payments reduce that balance a little bit every month. And as we go on, the balance will eventually run down to zero. So it's that same present value formula that we talked about a little bit earlier. So let's pull that up. Now the one I'm using is slightly different than the one that you'll see in the textbook, or the one that we've been presented in previous videos. I tend to like to use this one myself a little bit better. In this one I'm using I is R over M. The other one uses the notation I is R over M, and then they also use N, which is the total number of payments, which is M times T in there. So it's the same formula, just a little bit different notation in there. PV is the present value, your loan amount. R is the payments that we're trying to find, the size of the payments. The interest rate that we're looking at would be 0.04508. That's your interest rate as a decimal. Since we're doing monthly payments, M would be 12. We're making 12 payments a year. And that exponent is going to be negative 12 times 30, because we're looking at a 30-year loan up there. So the other formula would have 12 times 30 is 360. So that the other formula would have N, which is negative 360, which is the total number of payments that you're going to make. But it's the same thing, just the same thing. And then on the bottom, you've got I again, but I is also R over M. All right, so there's that. Let's hop over and plug that into our calculator and see what we get. I'm going to start by working out the number on the left-hand side of the equation, or on the right-hand side of the equation, excuse me. So hop over to my calculator, and that was parenthesis 1 minus, and then another parenthesis 1 plus 0.04508. divided by 12. Close off the parentheses there. I need to raise that to the negative 12. I'm going to put that in parentheses. This calculator is jumping up into the exponent. And so it will do this calculation before it does the other ones according to the order of operations. But if it's not, if you don't have your calculator jumping up into there, some versions of the TI calculator don't do that. You do have to put that multiplication in parentheses. Okay, and I'm going to left arrow to get out of the, excuse me there, left arrow to get out of the exponent, and a parenthesis to close off the top of the big fraction. And then I want to divide by R over M again, 0.04508 divided by 12. Okay, and that gives us 197.176137. All right, and it's very important that you keep all those digits. They will make a difference in your calculation, and so you want to be as accurate as you can in there. Okay, so jumping back to our equation. So the right-hand side of this equation worked out to be 197, and so to get R by itself, it's being multiplied by R. I just need to divide by R. So let me jump back to my calculator, and I want to take 300,000. I always kind of got to double check twice to make sure I have the right number of zeros. And I'm going to use the A and S. It's up here above the negative sign down there. It's the second function up there. And that will use all the digits that the calculator has calculated. I think it does 14 places after the decimal point. So it will be as accurate as we can get here. And it gives us $1,521.48. So Michelle's payments here are going to be, and so we get payment amount of $1,521.48. All right, and so we can do some more calculations here. We can say how much does Michelle pay back to the bank? Well, she is going to pay $1,521.48 per month for 12 months a year for 30 years. So that would be a little over $500,000. So $547,732.90 would be the total amount that Michelle is going to pay back to her bank. So that $15,000 a month for 12 months a year for 30 years totals up to the $547,000 and a little bit more month per month. And then how much interest did Michelle pay? Well, she borrowed really $30,000, but paid back, or $300,000, but paid back $500,000. And so the difference would be how much interest over the life of that loan Michelle is going to pay, $247,732.90. And so the next thing I want you to do is I want you to answer these questions. Do this calculation for Manuel. With Manuel's interest rate, how much is he going to pay? And how much is he going to pay? And it might help you to pause the video right here. This is going to be where I end it, but you might want to pause it just so that you have this showing on the screen in OneMap as you work out your questions. There is going to be one to ask you to compare Michelle's interest with Manuel's. And so if you pause here, you'll have it showing on your screen and it won't go to the YouTube preview of the next video.